Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the Empire Fintech Conference in New York City. Joining us for this segment, we have Mark Chorazak, partner at Shearman Sterling. We're going to take a look at the regulatory environment post Silicon Valley Bank. Mark, it's great to have you with us. Welcome to TradeTalks.
Great to be here. Thank you.
It sounds scary when we hear about bank failures and blow-ups, but there is that potential to rework regulatory framework. Where do you think we are right now?
Sure. Well, I think we're still in a assessment stage, like trying to figure out what went wrong, what might go wrong in the near term, and then developing responses to that. So for now, it's actually, most of the work has been by the FDIC, right, in closing down Silicon Valley Bank, Signature Bank, and then perhaps readying for other failures if and when they come. In terms of a legislative response, I think we're thinking that the likelihood of Congress passing any laws in the near term are slim. So that turns to the regulatory agencies and what they're going to do about it. I think certainly a main area of focus is going to be liquidity risk management and thinking about what banks should be doing better there, what examiners should be doing better as well, and looking at regulated institutions and developing some type of solutions, guidance, or perhaps new rules.
Was it idiosyncratic to SVB, or do you think a little bit more systemic? I mean, SVB operated without a risk manager for 10 months. I mean, how does that even happen?
You're asking me too. It's pretty remarkable, a set of facts. I think in some sense we don't know yet, right? I think there's some things that are very unique to Silicon Valley Bank. The fact that they did have such a high concentration of uninsured deposits, the fact that they were so concentrated in one sector, the fact that they didn't have the best liquidity risk management, they didn't have a chief risk officer. All these things are, in some sense, idiosyncratic to Silicon Valley Bank, but there is something happening, right? And perhaps there are some historical parallels to the savings and loan crisis of the 80s, where you had this unique environment of rising interest rates, like we have today, and a lot of struggling banks that have long-dated assets, long-dated securities, and they're now faced with this pressure of paying more for deposits than they were previously, and that's creating new pressures. So I think we're still in this stage where it's too early to tell. You're seeing a lot of distress in other regional banks at the moment.
Right. Let's talk about the M&A environment here. The deal market was cooling off even before some of the bank failures. Are deals happening now? And if so, where are they happening?
Sure. Well, I think one thing's for sure is that there needs to be more bank deals, bank mergers. I think one unassailable fact is that we just have a lot of banks. The U.S. banking market is not very concentrated. You have 4,000, 5,000 banks or something like that, which is just remarkable. So I think there is a real thesis for more mergers, and that's going to create a healthier banking system, right? I think it's going to be easier for examiners to regulate these banks, and so I think there is a real case for mergers. Now, whether mergers are actually happening, I think without a doubt, it's a tougher environment to sign up deals. It's going to be a tougher environment to get approvals. I don't think that means that deals are dead by any means. I just think that it's going to take the due diligence process is going to be much more involved. And then in the regulatory application process, when the agencies, particularly the Fed is reviewing deals, I think they're going to be a little bit more searching in terms of these fundamental questions like liquidity risk management. Is the pro forma organization ready to deal with a larger banking franchise? Which
is what makes it so interesting in the fintech space, because everything was really predicated on a good story and valuation, and that's kind of what got venture capital interested in it. In a way, I kind of think this reset had to happen, right? Yeah. You need to learn how to have governance in terms of your management practices. Profitability matters, revenue streams matter, because at the end of the day, it's the public investor when these companies do come to market that are the ones left holding the bag.
Absolutely. So. Yeah, I mean, it's a great point. I mean, I think you're seeing the same kind of unique pressures hit the non-bank financial services sector, or fintech, right? And like you said, there's just these fundamental things that matter: liquidity risk management, regulatory compliance, making sure there's an architecture in place to deal with customer complaints, regulatory inquiries, and the like. And so I think we're in the age of discipline, right? Like maybe the last 10 years, perhaps in these circles here, sometimes you heard the phrase "fake it till you make it." Well, I think those days are over. I think investors are putting much more scrutiny, and I think healthy scrutiny on fintechs, and you're going to see the stronger ones emerge victorious, and perhaps ultimately be survivors and stronger players. And I think it really gets to the heart of how are they serving their markets, what's their legal and regulatory infrastructure and compliance, and those are going to be the survivors.
Mark, appreciate the insight. Thanks
My
for joining
pleasure.
us on Trade
Nice to meet
Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.